In the world of options trading, the short put strategy stands out as a powerful tool for generating income with a bullish bias. This strategy is particularly appealing to traders who have a positive outlook on a stock, but prefer a more conservative approach compared to outright buying the stock. Unlike simply buying and holding a stock, hoping for its price to appreciate, selling put options allows traders to profit from their belief in a stock's stability or upward momentum while collecting premiums up front. This upfront premium can provide a steady stream of income, which can be especially attractive in a volatile market. This strategy, however, is not without its risks, and a thorough understanding of its mechanics is crucial before implementation. Traders must be aware that if the stock price falls significantly, they could be obligated to purchase the stock at the strike price, potentially leading to substantial losses. The basic premise of a short put involves selling, also called writing, a put option contract. This means the trader is agreeing to buy the stock at the strike price if the option is exercised by the buyer. This contract gives the buyer the right, but not the obligation, to sell a specific number of shares of the underlying stock at a predetermined price, the strike price before or on a specific date, the expiration date. The seller, in turn, must be prepared to fulfill this obligation if the buyer chooses to exercise the option. In exchange for granting this right, the put seller receives a premium, which represents their maximum potential profit on the trade. This premium can be a valuable source of income, but traders must always weigh the potential rewards against the risks involved. The allure of the short put strategy lies primarily in its ability to generate income through premium collection. This strategy is particularly appealing to traders who are looking for a steady stream of income without necessarily having to predict the exact movement of the stock market. By selling a put option, the trader is essentially taking on the role of an insurer, providing a safety net for other investors who might be looking to hedge their positions. By selling a put option, the trader immediately receives a cash inflow, regardless of whether the underlying stock price moves up, down, or sideways. This immediate cash inflow can be used for various purposes, such as reinvesting in other opportunities, covering other trading costs, or simply adding to the trader's cash reserves. This upfront premium represents the market's compensation to the put seller for taking on the obligation to potentially purchase the stock at the strike price if it falls below that level. Essentially, the put seller is being paid to take on the risk that the stock might decrease in value, which can be a lucrative opportunity if managed correctly. The amount of premium received for selling a put option depends on several factors, including the current stock price, the strike price, the time remaining until expiration, and implied volatility. Implied volatility, in particular, plays a significant role as it reflects the market's expectations of future price fluctuations. Generally, put options with higher strike prices and shorter times to expiration command lower premiums, as the likelihood of the stock price falling below the strike price is lower. Conversely, those with lower strike prices and longer times to expiration command higher premiums. This is because the extended time frame increases the probability of the stock price dropping below the strike price, thus increasing the risk for the put seller and, consequently, the premium they receive. The short put strategy is inherently bullish. By selling a put option, the trader is essentially expressing their belief that the underlying stock price will either remain stable or increase over the life of the option contract. This bullish outlook stems from the fact that the trader's maximum profit is realized if the stock price remains above the strike price at expiration, allowing them to keep the entire premium received. Conversely, a bearish outlook on the underlying stock would make the short put strategy unsuitable. If the stock price were to fall significantly below the strike price, the put buyer would likely exercise their right to sell the shares to the put seller, potentially resulting in a loss. Like all options strategies, the short put comes with its own set of risks and rewards. The maximum potential profit is limited to the premium received when selling the put option. This occurs if the stock price remains above the strike price at expiration, rendering the option worthless and allowing the trader to keep the entire premium. However, the potential loss on a short put is theoretically unlimited. This worst-case scenario arises if the stock price falls to zero before expiration. In such a situation, the put buyer would exercise their right to sell the shares to the put seller at the strike price, resulting in a significant loss for the trader. Short-term focus, capitalizing on time decay. The short put strategy is generally considered a short-term trading approach as it benefits from the passage of time. One of the key factors influencing option prices is theta, which represents the rate of time decay. Theta reflects the fact that options with less time remaining until expiration have less time for the underlying stock price to move in a favorable direction. As time passes, the value of the put options sold will typically decrease, all else being equal. This time decay works in favor of the put seller, as they can potentially buy back the option at a lower price than they sold it for, pocketing the difference as profit. NVIDIA in focus. A practical example. Let's illustrate the short put strategy with a practical example using NVIDIA Corporation, a leading technology company specializing in graphics processing units. Assume that NVIDIA stock is currently trading at $250 per share and you have a bullish outlook on the company's future prospects over the next month. You decide to sell one put option contract with a strike price of $240 and an expiration date 1 month out. The premium received for selling this put option is $5 per share. Since each option contract represents 100 shares of the underlying stock, your total premium received would be $500. Entering the trade, selecting your strike and expiration. When entering a short put trade, selecting the appropriate strike price and expiration date is crucial. The strike price determines the level at which you are willing to buy the underlying stock, while the expiration date dictates the time frame for your trade and influences the amount of premium received. In our NVDA example, you chose a strike price of $240, which is below the current stock price of $250. This indicates your belief that NVDA stock will not fall below $240 within the next month. The 1-month expiration date aligns with your short-term bullish outlook and allows you to capitalize on time decay. Exiting the trade profiting from price action and theta. There are several ways to exit a short put position, depending on your outlook and risk tolerance. Each method has its own set of advantages and potential drawbacks, so it's crucial to understand them fully before making a decision. If NVDA stock price remains above the strike price of $240 at expiration, the option will expire worthless, and you get to keep the entire premium of $500 as profit. This is the ideal scenario for a short put position, as it maximizes your gains with minimal effort. Alternatively, you could choose to buy back the put option before expiration to close your position. This strategy can be particularly useful if you anticipate a change in market conditions or want to free up capital for other investments. This might be desirable if NVDA stock price has increased significantly, pushing the put option's price lower due to time decay and a decrease in its intrinsic value. Time decay, or theta, works in your favor as the option approaches expiration, reducing its value and making it cheaper to buy back. By buying back the option at a lower price than you sold it for, you can lock in a profit. This allows you to realize gains without waiting for the option to expire, providing flexibility and potentially reducing risk. Understanding these strategies can help you make more informed decisions and optimize your trading outcomes. Theta's gift. Time working in your favor. As mentioned earlier, theta or time decay plays a significant role in the profitability of short put options. As each day passes, the value of the put option you sold will typically decrease, assuming all else remains constant. This time decay works in your favor as the put seller. In our NVDA example, even if the stock price remains relatively flat over the 1-month period, the put option's value will still decline due to time decay. This allows you to potentially buy back the option at a lower price than you sold it for, even if NVDA stock price doesn't move significantly in your favor. Mastering short put's key takeaways for income generation. The short put option strategy offers a compelling way for investors to generate income with a bullish bias. By selling put options, traders collect premiums up front, while expressing their belief in the underlying stock's stability or upward momentum. However, it's crucial to remember that short puts, like all option strategies, carry inherent risks. Understanding these risks and implementing proper risk management techniques is essential for successfully incorporating short puts into your investment arsenal. Thank you for watching. Good luck with your trading, and do not forget to like and subscribe. See you next time.